super long-term business cycle and related trends in the stock market. Hello, I'm Rich Posh, and for the Critical Point podcast, it's June 26, 2020. We're going to take a super long-term cyclical view here. This is a yearly chart. It's supposedly the S&P 500, but the S&P 500, I think, started in 1885. So this particular company, charting company, has added data from others. So it goes all the way back into the 1790s. I quickly want to point out a 216-year cycle top occurred in 1835. It fell into at least a 36-year cycle top. These are all super cycles I'll explain in a moment. And probably fell like 70%, okay? And it then turned into a bull market when it was supposed to be a bear market from this 216-year high into a 216-year low that occurred in 1932. So what went wrong? Why wasn't it a 100-year bear market? And you will hear people talking of a 100-year bear market. They've been trying to forecast it for many decades, and they've been wrong. I don't think they understand the 100-year bear market cycle in terms of timing, okay, or bear market, I should say, that fits within a larger cycle. Now, I've called this cycle a 200, not only 216-year, but I put my name on it to reward myself for decades of research, thousands of hours. So what went wrong is we are printing money. We are hard workers. We like to trade, invest, do business, and we engineered a nice bull market, but look at the struggle. It had complications and problems. Civil War, 1918 pandemic, World War I, plenty of depressions and recessions and panics on Wall Street, bank failures, a real struggle. Our GDP over 100 years only grew 1,000%, nominal GDP per capita, okay? Whereas from 1930s to today, it's growing 10,000%. So we did something off this 1929-1932 crash. We said, we've had enough of these crashes and depressions. We've rigged the system to not have depressions. Now, someday it may get away from us and we'll get depressions. And we just went through a great recession that should have ideally been a depression. All right, so we're manipulating these cycles, but I wonder if we're losing our edge here. At any rate, what occurred is we are in a super cycle bull market from the 216-year cycle low, and it's due to top out for a 216-year top like it did back in 1835 around late 2030s to early 2040s. And a similar cycle bottom is due back that we saw back in the 1840s is due in the 2040s, okay? Maybe a bit later. What we don't know is, does this mean a 1929 crash is coming? And the answer is it's the same cycles as 1929 crash, but they're flipped around. The bottom is the top is the bottom, the polarity is different. And you have to go back to 1835 to see what that means. And we don't have a lot of history going back. We don't have enough of these cycles to get a feel what they really do. So it's possible this means we're only going to get like a 50% crash or something like that will manage it, manipulate it. We don't get a 70 to 90% crash, which is what I believe is due. And 1929 crash was nearly 90%. I'm not convinced we're really due for that. I think there's a little something different here. And again, I think we can manage and manipulate things if we want to. If we do nothing, I'm very convinced it'll get close to 90% crash, okay, at least 70%. If we do something, I think we can contain it to 50 to 70%, all right? Now, what I want to point out is look at these bull markets since the 1930s, 1940s, since World War II. This is a super cycle bull market inside of the 216-year bull market. And what occurs is that there's a 36-year cycle here. There's another 36-year cycle here, but it's also a larger 72-year cycle, the second most important super cycle, and that goes into the 2008-2009 crash, okay? And it turns out some economic data was the worst since the 1930s Great Depression. As it turned out, we were supposed to have a 79% drop in the stock market. We were supposed to have a bit of a depression, but not a 1930s depression. And I correctly warned we were probably going to contain it and may only get a 40 to 60% drop in the stock market. That's just what occurred. So we got a new statistic for that kind of cycle, but I correctly forecast that. Okay, now the key is they have these lengthy trends. Why can't we have another one? I think it means this will work going into a late 2030s super cycle top, and then we have to worry about maybe a crash. If not, it could be a long, drawn-out, bad bear market, but not a true crash. We just don't know yet, but it's a possibility. But in the meantime, the super cycle looks like it's bullish for a while yet. So inside of that are 9-year cycles, and we're probably placing a 9-year cycle bottom this year or next. And then we're going to get the next leg higher of these super cycles. What it boils down to is every fourth 9-year cycle bottom creates a bear market of like 40 to 60%. Every eighth super 9-year cycle bottom creates a bear market of 70 to 90%, and in the past was depressions, and sometimes for the 36 or even 9-year. Okay, every 16th 9-year cycle seems to be something like a depression, if not the Great Depression, and was the Great Depression, and could be 70 to 90% drop in the stock market as well. So that's a series. That's how this works. It's really interesting that it has something to do with multiple generations when we cannot build the economy anymore, we cannot borrow anymore, we can't create more debt, we can't print more money, and then something slips and falls apart, and then we just panic more than what we would over the smaller cycles. And it gets away from us, it breaks down. And this is what the Federal Reserve is trying to prevent, but I just wonder if it's going to fail in a few decades here. At any rate, the bottom line here, however, is we do have a super cycle uptrend, so the 9-year cycles, at least at the moment, should not create a 1929 crash. It's a ways off. At the moment, we've probably just seen a serious correction of a super cycle uptrend, and because this is a logarithmic chart, stock market could go up by huge amounts yet in the next 20 years. I think the low of this year or next is going to be a major support level to warn us of some other kind of problem that if the market goes below that low, okay? So long-term investors can get on board and just say, if it goes below the 2020 or 2021 low, I guess I better protect myself. Something could be significantly wrong. And we want to do that more so once we get into the late 2030s, early 2040s. Hopefully we come up with a much higher low to use as a sell stop to protect ourselves. So there's our super cycle scenario. If you study your history, you're going to find out there's a reason behind this. This is just not fairy tale stuff. This is how we do business, all right? And the super cycle is bullish. Manage your risk relative to analysis of others. Thank you.